Hi everyone. Before I start this video, make sure that you're a part of my Discord server by joining the link in the description box below. And in this video, we'll be going over A-Level Accounting 2024 October-November Paper 3-3 question number 1. This is the structured paper 3, which consists of 3 questions. Each of them will be of 25 marks, and the total time limit for this paper is 1 hour and 30 minutes. So ideally, you should be spending about 30 minutes in order to solve each question. And in this video as well, we'll be attempting to solve this question number 1 under 30 minutes. So without any further delay, let's get started. Andy and Betty had been in partnership for 30 years. They shared profit and losses equally as they spent equal numbers of hours working in the business. Betty no longer wanted to spend so many hours working for the business. Andy suggested that he should work most of her hours, but that the profit sharing ratio should be changed to 4:1. Previously, they used to share profit and losses equally. Betty agreed, and the partnership agreement was changed on 1st October 2023. So this is the case of partnership changes, where the profit sharing ratio has been changed. And the date of change was 1st October 2023. The partners knew that their capital accounts should be adjusted for the goodwill which had arisen over the years, but were not sure of the value of the goodwill. Goodwill was not to be retained in the books of accounts. Remember that whenever there is changes in partnership agreement, we always need to adjust the goodwill value within their capital accounts of the partners. What we do is we add the goodwill based on the old ratio and subtract the goodwill based on the new ratio in order to figure out the updated value of the capital balance right after the change in partnership agreement. Let's take a look at the first question. We need to explain why the partners were not sure of the value of the goodwill. Remember, in this case, we're talking about partnership changes, right? So if there was a case of acquisition, it means that whatever goodwill there existed would be the purchased goodwill, because the acquiring company would pay for that value of the goodwill. So the value itself would be very objective. But in this case, the partners themselves have to come up with the value of the goodwill. They have to decide mutually. And this is a case of inherent goodwill, which is the goodwill that exists within the business. And there is no universally accepted objective formula in order to calculate the value of the goodwill. That is why the partners were not sure of what value to use. Let's write it down. Because it is inherent goodwill, and there is no universally accepted objective formula to calculate the value of the goodwill. That's all for the first part. Let's move towards the second one. We now need to state which partner would prefer the value given to the goodwill to be as low as possible, and we need to give the reason for the answer as well. Okay. What I said before was the adjustment for goodwill will be done in a way so that we add the goodwill based on the previous ratio and subtract the value of the goodwill based on the new ratio to their existing capital balance so that we can get the updated value. And in this case, remember that they previously used to share profits and losses equally. It means that for Andy as well as Betty, we'll be adding 1 parts each, or divide the value of the goodwill equally. Then according to the new ratio, we need to subtract it. So based on the new ratio, it will be minus 4 parts, minus 1 part. So in total, Andy will be losing a higher value, whereas Betty's value will not change much. He will be losing a greater value due to the greater value of the goodwill. That is why Andy would be the partner who would prefer the value of the goodwill to be lower, so that the effect into his capital account balances will also be lower. Let's write it down. So the partner would be Andy in this case, and the reason is because the higher the value, given to goodwill, the more his capital account balance will decrease. That is all for the second part. Let's move towards the next one. We have been given some additional information. The partners finally agreed on a value of 100,000 for the goodwill and the capital accounts were adjusted. Later that year, Andy decided that he no longer wanted to work the extra hours and the partners decided to sell the business. The business was acquired by AD PLC on 31st December 2023. Now, this is a case of acquisition. It took over all the assets and liabilities of the partnership except for the bank account for a purchase consideration of 620,000. The partnership's statement of financial position immediately prior to the acquisition showed the following. So Andy's capital and current accounts total is given, Betty's capital and current accounts total is given, and we have been given the bank account balance as well. Since this is debit, it means that this is a positive bank balance. Then the partnership also paid legal fees of 3,000 in relation to the sale of the business. Okay. We need to calculate the profit on realization made by the partnership. So for this one, we can just prepare a realization account. Okay. Remember that normally what we do is we put in the value of the asset on the debit side. So that will be at the net book value. Then we put the value for which it was being settled, which in this case is the purchase consideration, on the credit side. Then we repeat the same process for liability. For liability, the net book value will go on the credit side, then the value at which it is being settled will go on the debit side. Then in this case, we also have the cost of dissolution, legal fees paid in relation to the sale of the business. This will always be recorded on the debit side within the realization account. And after recording all of these, we will have to figure out whether there was a profit or loss. But in this case, we only have the value of the capital and current accounts and the bank account. And we have been told that all the assets and liabilities except for bank had been taken over. So in this case, instead of figuring out the asset and the liabilities value separately, we just figure out the value for net asset. Net asset, it just means asset minus liabilities. And in this case, the net asset that we will be calculating will only be the assets and the liabilities that are taken over. So this should not be including the bank account. We can just utilize our accounting equation. We know that asset will be equal to capital plus liabilities. So in this case, we have asset, which was taken over, plus bank, which is also the asset, but this was not taken over. So we can just input the value, and the capital and the current balances are given right here. So that will be 221,500 plus 291,300 plus liability. So asset minus liability. The required net asset value is just going to be 462,900. So we can just include this net asset at the net book value on the debit side. So 462,900. This will be the net asset. Now we need to include the purchase consideration on the opposite side. The total purchase consideration was 620,000, which is being paid by AD PLC. So on the credit side, we have AD PLC 620,000. This is the value which was given in order to take over the net asset of 462,900. Then there was the cost of dissolution as well, 3,000. This will go on the debit side. So 3,000 cost of dissolution. Now we just need to check which side is heavier, and in this case clearly credit side is heavier. So the balancing figure will be on the debit side. If we require a balancing figure on the debit side, that refers to profit on realization, which is what we need to figure out in this case. So the total from the credit side will just be 620,000. Now the profit on realization will be 620,000 minus 3,000 minus 462,900, which results in 154,100. That's all for the third part. Let's move towards the next one. We now need to discuss how Betty's decision to agree to Andy's suggestion to change the partnership agreement impacted Betty. We need to support our answer with calculations. Okay, so the only thing that changed was previously the profit sharing ratio was 1:1. Due to the partnership changes, the profit sharing ratio was 4:1. Now we can look at the impact on the share of profit on realization for Betty. So share on profit, or we can say share of profit on realization for Betty. So before partnership changes, she will be getting half of the profit on realization. So 154,100 divided by 2, which is 77,050. And now due to the change in partnership agreement, her share of profit will decrease because 4 out of 5 parts belongs to Andy and only 1 out of 5 parts belongs to Betty. So that will be 154,100 times 1 out of 5, which results in the value of 30,820. So we can see that due to the change in partnership agreement, the amount Betty receives from profit on realization is, let's figure out the difference. So 77,050 minus 30,820. So that is 46,230 less. Now, due to the partnership change, there will also be adjustment of goodwill. So let's figure out the increment in Betty's capital due to goodwill. The goodwill value is 100,000. Okay, and previously, okay, we do not need to figure out the previous value. So we can just say increase in Betty's capital due to adjustment of goodwill. So we would add the goodwill based on the previous ratio. So 1:1. The total goodwill was 100,000. So half of 100,000 will be added. Then we will subtract 1 out of 5 parts of 100,000 because the new goodwill value based on the new ratio will have to be subtracted. So minus 100,000 times 1 by 5. This results in 30,000. So we can see that due to the partnership changes, Betty's capital will increase by an adjustment of 30,000. This is the adjustment for goodwill. But she would be receiving 46,230 less as part of her profit on realization due to the partnership change. If she were to continue with the previous ratio, she would be getting the value of 77,050. But as per the new ratio, she will only be getting 30,820. So in this case, we can say that in conclusion, Betty will be financially worse off than if the partnership had been sold at the end of the change in partnership agreement. So that was at the date of October 2023. But since the acquisition was done at the date of 31st December 2023, she was worse off in this scenario. Let's write it down. Therefore, Betty is financially worse off than if the partnership had been sold end of September. This means that if Betty were to sell the partnership business, instead of changing the partnership profit or loss sharing ratio, then she would have been better off. So rather than continuing for the extra 3 months. And we can also see that instead of selling the partnership business, an alternative strategy could have been to admit another partner. So instead of selling the partnership business, an alternative strategy could have been to admit another partner. Alright, that's all for this part. Let's move towards the next one. We have been given some additional information. The purchase consideration was settled by 200,000 in cash and 600,000 ordinary shares of 0.50 each. The total purchase consideration was 620,000, out of which 200,000 was settled in cash. Now the remaining settlement of 420,000 will be made, sorry, that's an extra zero, 420,000 will be made by 600,000 ordinary shares of 0.5 each. Okay, so in this case, the ordinary share capital value will only be the number of shares, 600,000, times the par value, which is 0.5. So this will only be the value of 300,000. So out of 420,000, 300,000 is the ordinary share. The remaining value will be share premium. So 420,000 minus 300,000, which is also 120,000. Then assets and liabilities were taken over at the following values: premises, fixtures, inventory, trade payables. Okay, we also need to record the value of the goodwill. And remember, goodwill is just the purchase consideration minus the net asset. So in this case, the net asset is just going to be asset minus liability. So premises, fixtures, and inventory are assets, so those will be added, but trade payables is a liability, so we need to subtract it. So the net asset value is just going to be 510,000 plus 18,000 plus 42,200 minus 15,600, which results in 554,600. Okay, so purchase consideration is 620,000. Net asset is 554,600. So the value of goodwill will be 65,400. Now we need to prepare the journal entry in the books of AD PLC to record the acquisition of the partnership. A narrative is required. Okay, so we just need to record all of the assets taken over on the debit side, all of the liabilities taken over on the credit side, and the settlement of purchase consideration on the credit side as well. So we can start with premises at the value of 510,000. Then we have fixtures at the value of 18,000. Then we have inventory at the value of 42,200. Then we have goodwill, which has a value of 65,400. Now we can record the liabilities, so trade payables. On the credit side, it has a value of 15,600. Then we have ordinary share capital with the value 300,000. Then we have the share premium, 120,000. Then some of it was settled by cash as well, 200,000. So we can record it under the heading of bank. And remember, this is in the books of AD PLC. By paying it through cash, their bank balance will decrease. Decrement in bank balance means a decrement in asset. So that is why it is recorded on the credit side. Then they issued additional ordinary shares. By issuing ordinary share, their ordinary share capital and share premium will increase. So the increment in equity will be recorded on the credit side. That is why it's on the credit side. And then by acquiring all of the asset and liabilities, their value of asset will increase and the value of liability will also increase. That's why the increment in asset is on the debit side and the increment in liability is on the credit side. And you can also verify whether the total of the debit side and the credit side is equal, because the journal entry should have debit and credit equal. In this case, the narrative is also required. Narrative just means to write down your transaction that you have been recording. In this case, the transaction we are recording is the acquisition of partnership business of Andy and Betty at the date of 31st December 2023. And we always need to start the narrative with the word being. So being the acquisition of partnership business of Andy and Betty on 31st December 2023. That is all for this part. Let's move towards the next one. We now need to advise Betty whether she should keep her shares in AD PLC or sell them. We need to justify our answer. This is of 5 marks. So 2 marks on why she should keep it, 2 marks on why she should sell it. Let's start with keeping the shares. So whenever we are acting as a shareholder, we will always expect a dividend. So that could be her steady source of income because she no longer now has the partnership business. So the dividend income could possibly replace the share of profit from the partnership. Let's write it down. She would hopefully get a steady income from dividends to replace the share of profit from partnership. And instead of selling the shares right now, if she keeps the shares for a longer time and then sells it at a later date, then there might be a higher chance of profit. Let's write it down. There is a chance of profit on sale if she keeps them for some time. Now we need comments on why she should sell it. We might say that by selling the shares, she will get some funds and she might want to invest those funds in another business. Let's write it down. She might want to invest the funds in another business. And another reason for her to sell the shares would be because she is not sure about the dividend or the share price. In future, the share price might further decrease, which would lead to a loss on sale. Let's write it down. She might be concerned that the dividends or even the share price might decrease. Now, based on these factors, we need to make a final decision. Now, I would suggest that Betty should be keeping her shares in AD PLC because in order to sell the shares, we would also have to pay a commission. So we wouldn't want that. Let's write it down. Betty should keep her shares in AD PLC as there would be commission involved in selling them. Okay. That's all for this part as well as the entire question. If you found this video useful, make sure that you like the video and leave a comment below. And make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of the videos in the future. Thank you.